Why did NASDAQ stock prices fall during the dot-com bubble? Imagine a time when everyone believed the internet would change the world overnight. That was the late 1990s, a period full of excitement and big dreams. The NASDAQ stock market soared as investors rushed to buy shares of new internet companies. Many of these companies had no profits and no clear plan to make money, but their stock prices kept climbing. It was like a giant hype train fueled by hope and hype. The main reason for the fall was that many of these companies were overvalued. Investors based their stock prices on what they thought these companies could do in the future, not on how much money they were actually making. When a company has no profits, its stock price can become disconnected from reality. This created a bubble where prices were inflated for beyond what the companies were worth. Another factor was the frenzy of speculative investing. Both regular folks and big institutions bought stocks because they feared missing out on the next big thing. This demand pushed prices even higher, creating a false sense of security. People were buying stocks just because everyone else was, not because the companies had solid business plans. Many startups focused on growing their market share quickly rather than building sustainable businesses. They spent a lot of money on marketing and infrastructure but didn't make enough revenue to support their high stock prices. When the excitement started to fade, these companies couldn't keep up and began to fail. Venture capitalists who provided funding to these startups also grew cautious. As the bubble expanded, they became worried about losing money. When funding slowed down, many startups ran out of cash, leading to bankruptcies or being bought out at lower prices. Around 1999 and into 2000, investors started realizing that many of these companies were overhyped and unlikely to turn a profit. This caused a massive sell-off of stocks. The NASDAQ index, which had hit record highs, dropped about 75% from its peak in March 2000 to October 2002. The economic context played a role too. During this time, interest rates were very low, encouraging risky investments. But when the Federal Reserve raised rates and worries about overvaluation grew, the market quickly corrected. Looking back, the dot-com bubble was a mix of innovation and excess. People believed the internet would revolutionize everything, but the burst showed that hype alone can't sustain a market. It was a lesson that solid business fundamentals matter more than just excitement and speculation. The fall of NASDAQ stock prices was a clear sign that markets need balance and realistic expectations, even in times of rapid technological change.